Thank you very much for that warm welcome and opening there, Madison. And good morning, everybody. Welcome, bienvenue. Thank you so much for joining us. And on behalf of the Canada Life team, it's truly a pleasure to be here with you today. Before we begin, we acknowledge that we're gathering today from many different settler locations across the territories, sorry, my apologies, of the Turtle Islands. And this, of course, is known as North America, where Indigenous people have been the original stewards of the land. We also recognize that many of you are likely joining us from communities across Ontario, and we're grateful to be sharing this time together. Today's session, hosted by GovernWise, an Ontario-based organization that focuses closely on partnerships with First Nations across the province. And we're so very thankful for your leadership and your care in bringing us together for this conversation. I'm joining myself from Winnipeg, and my colleague Mike is joining from our office in Toronto, which is located on the territory lands of the Mississaugas of Credit, the Anishinaabe, and the Haudenosaunee, and the Huron-Wendat nations. We also acknowledge the Dish of One Spoon Covenant, a living agreement rooted in the principles of mutual respect, collective stewardship, and the shared responsibility to care for the land and its resources, principles that continue to guide relationships across the region today. So Canada Life does acknowledge, of course, the harms of the past, and we respect the history, the people, and the land in the communities where we live and operate. We are committed to building meaningful relationships and moving forward together in the spirit of truth and reconciliation, guided by shared principles of respect, equality, and collaboration. So our agenda today will begin with why we're investing and why investing is so important. Ultimately, the purpose of investing is to build wealth and financial security that supports your overall financial well-being. And we'll talk about what that can look like in practice and how you may be able to apply that to your own life and planning. Next, we'll dive into an introduction to investing, covering the benefits of investing and reviewing some of the more common technical terms you may hear when learning about how investment works. As part of that conversation, we're also going to dive in a little bit further into risk. With investing, growth always comes with some level of risk. So we want to break this down for you in practical ways to make your investments more efficient while managing risk careful as possible. Finally, we'll transition into community investing, looking at how investing can be used as a tool to support and strengthen your community. For those of you who are considered or are already serving as a fiduciary overseeing community assets, we'll discuss the key responsibilities to be mindful of, along with where you can seek support and guidance on carrying out that important role. With that said, please allow me to pass it over to my colleague, Mike. He's Senior Education and Engagement Consultant on our team at Canada Life, who will get us kicked off with our Investing 101. So Mike, over to you.
Great. Thank you so much, Kristen. And such a pleasure to be here today. You know what? We're passionate. It's the start of the year. What a better way, I think, to kind of kick things off and to talk about something I know Kristen and I are very passionate about, which is investing. But with that in mind, I think it is first important to talk about the impact of responsibly investing and kind of why do we do it? Why do we care about this to begin with? And oftentimes it really is talking about financial well-being and the desired lifestyle that we all want to have and how it really impacts all of our lives. So while financial priorities are not the same in every Indigenous community, I think there are some things that are universal when it comes to having good financial well-being. And what does that ultimately mean? So first, I'm a big proponent of financial literacy and increased financial literacy, which allows you to be more efficient with your resources. You have to support yourself and not only yourself, but also your community. I think of how supporting youth agency and making sure, for young people, having good financial literacy is key for their lives and building those foundational blocks where they can have things like managing debt and investing with confidence. So some of you may feel the importance of this, but for young, maybe they don't think about it. But seeing yourself as a mentor and making sure that as a community we build that financial literacy is really key. Obviously, preparing for retirement is another huge one where people oftentimes don't think about it. They think about the day-to-day life or the month-to-month. They don't think of years ahead. It's a very much a financial and an emotional event. So preparing for this is key to make sure you have that smooth transition. And also making sure that the community is well funded. again, not only for you, yourself, but also for future generations is really critical. And having that good financial well-being, that financial literacy is certainly key. I'll also say that it can also provide some defense, some things that you might not inherently see, but preventing things like fraudulent actions and being taken advantage of. So when we think of financial well-being, it's not only the things you see, but it's also the things that you might prevent from having to happen. So if you have the knowledge to understand what's important when we talk about investing and finances, I think it's something where it may prevent hardship as well, which is really critical for Indigenous communities. So that's really why we want to talk about this and some of the benefits. And what is good financial wellness? I think that's the next part of it is what does that actually look like? Or when we say the word financial wellness, what does that actually mean? You might interpret it in different ways. So we're going to provide a couple of suggestions in terms of what we think good financial wellness looks like. So first, it's really the ability to comfortably meet your financial needs and commitment. Again, finances can be a very emotional event as well, where you feel confident that you're not only making progress today, but making progress for your future goals as well. And you have the freedom to make the choices that you want in life, right? Where you're not stressed, you're not reactive, you're proactive in terms of your financial goals, and that you feel that they align with your values as well, right? That again, but we want to make sure money's working hard for us, for what's important to us. Good financial wellness can cater to that, certainly. You also have the ability to have financial resilience, so to maintain your financial well-being in the future, because we can all plan and we have these goals. Some things, there's snags that happen or things that are unpredictable. So good financial well-being is having the resiliency, the ability to be able to withstand those things that are unforeseen. And community financial well-being and sustainability. Again, investing with a purpose is one of the names of the titles here. So it's really the ability to make sure your money is being invested in a responsible way that caters to the goals for yourself and your community. And I think in terms of if you're in good financial standing today, it's still something that we can certainly prepare for and review because there could be unexpected financial impacts that can happen. And we're going to speak to, again, risks and investment performance later. But I think when you're considering your planning, understanding these unforeseen, but certainly something you need to prepare for, these impacts are critical. So things like unexpected illnesses and costly repairs. I know we're talking about 9 feet of snow, like maybe there's a flood in your basement, right? So these are all things where if you have good financial wellness, you're investing your money, again, it really helps the emotional side to feel prepared and confident to really concentrate on what's important to you and your goals itself. So with that in mind, I think I wanted to first establish ultimately, why do we talk about investing? And ultimately, it's there to support your financial well-being. So I want to transition now to where we talk about the benefit of investing and that introduction of what do we mean about investing and those future goals and what are the ins and outs of ultimately you have money, how do you have it working for you? What is the basic information you need to know? So some of it might be just a review for some of you. Some it might be new information. Again, we want to make sure we provide the basics. So first, why do we invest our money, right? And first, I want to say that investing your money is different from saving, right? So saving is simply setting money aside for your short or long-term goal. While investing is taking those savings and using it to buy an investment with the intention of ending up with more money than you started out with. And that's the first reason to invest, for the opportunity to increase the value of your savings over time. The next reason for investing is to protect your buying power. So, if you've been to the grocery store lately, you might notice that prices are going up. And the general increase in prices is known as inflation, which is a risk that we're going to discuss. Now, if you think about how much prices go up by the time you retire or by the time you have a long-term goal, this is again where investing is very important. Where investing your money gives you at least a chance to grow as prices increase and to help offset the impact of inflation and the ability to buy things and your goals to achieve your goals in the future. Finally, since investing your money gives you the opportunity to earn returns on your savings, it could also make achieving those goals easier and faster. So you'll have your investments doing the hard work for you rather than you have to put all the money aside for yourself. So again, very key elements here of why do we invest? Again, it's there to help your financial goals and financial well-being. So I always like this chart. So how do investments achieve growth exactly? Now, generally investments grow occurs when you buy an investment at a lower price and it goes up over time and you sell it at a higher price. Pretty basic. So I think it makes sense. Now, you might want to buy prices in low and sell your investments when they're at the highest. That's obviously the ideal. That's not always the case, by the way, but what you can see on this chart is historically speaking, market trends and what happens. And you may have heard of the terms bull and bear markets. So what we did here is we looked at historic bull and bear markets over the last 75 years and tried to see what the trends are, because none of us know what the next few months will hold. But I think over the long term, there are trends that we can rely on or view. So what you see here is the Toronto Stock Exchange and over a 75-year period. And what do you notice on this chart, right? So once you see in the teal color, this would be the bull markets. And on average, you could see they last longer. They tend to last longer than, say, the red on the screen that you see here. So in fact, the average bull market provides a market return of 106%, approximately over those 75 years. Now, the red you see on your screen indicates a bear market. So when I say bear market, it typically means when markets decline at least 20% from their highs. And what you can notice here is that the periods tend to be shorter in nature, but certainly they can be very emotional. If you think of your investments going down 30%, that's going to certainly invoke an emotional response. So keep in mind, although it doesn't look as high as the bull markets, certainly the emotional response can certainly be just the same, if not more. So trying to time the market is extremely unpredictable, and in most cases, it doesn't end up going well if you try to choose these times exactly. So really, what do you do with this, or what is the takeaway that I have for you? Is that there's not necessarily timing is the best answer, but it's certainly making sure that you're investing, that you're taking advantage of the markets as they're going up over time. As you have these long-term time horizons, these goals, that you're certainly taking advantage of it, keeping in mind that you want to make sure that it's in line with your risk tolerance and the goals that you have itself. But short-term markets can be very unpredictable. Over the long term, they generally go up more than they go down. Another basic concept of why investing works is really just the concept of compound interest. So that means the companies that you're investing in, they have earnings, they're paying interest when you invest, and you're reinvesting this benefit. So a very powerful concept. And I wanted to use an example in terms of a visual example to help explain this a little bit. And really, the idea of compound interest is like a forest growing in trees. So let me explain this a little further. So a forest grows two ways, right? So someone can plant the trees themselves. So that's like savings that you invest, where you're planting that tree for it to grow in the long term. But if you think of a forest, they also have seeds, right? Things like pine cones, right? Where they'll fall on the ground and they're all spread on their own. So even you took the initial action of planting that tree. You don't do anything after that, but you could see that more trees grow from these seeds and the pine cone. And that's really how compound interest works, where earnings pay dividends, and over time, with little effort from you, you build a forest with that one tree that you planted. So again, I think very powerful concept of how to build wealth ultimately. So consider this. I'm a numbers guy. I like to use numbers, and hopefully this helps as well. So consider $240,000 of saving in two different ways. So first is you save $500 a month starting at age 25. You experience 6% growth over 40 years until you're age 65. You'd have an account balance of $724 at age 65. So I think we'd all like to see that in our bank account, and you can kind of see how that would work over those 40-year periods. Now, the key is time, though, right? So this person started at age 25. So what if you know what, something happens, and now that if we've cut down time and you try to catch up, right? So if you're age 45 and you're saving $1,000 per month, you could see that the person's still investing $240,000, but the result is much different, right? So we can see that the result here, $464,361. So the difference is really that time, and that time of money being invested, working hard for you. Again, those seeds being planted, and that reinvestment where over a $500,000 difference in the balance because of that money didn't have enough time to invest. So again, I'm really passionate about having younger people get invested, understanding the power of compounding because it's a huge way to build wealth. All right, so now that we have that in mind, let's really start talking a little bit more in the weeds of how much growth and volatility you experience based on how you invest the money. So again, this might be a reminder for some, maybe for others, some new information. So really, investing terms, the first term I'm going to throw at you is called an asset class. And this is really how asset classes have different potentials for return and ultimately different risk levels. So there are three main investment asset classes that are typically thought of, right? So when we think of things like cash, we think of fixed income investments, and then we think of equity investments as well, real estate alternatives. So these are different types of asset classes that might be available to you when you decide you want to invest your money. So let's go a little bit deeper into some of the elements of these asset classes and what does it mean. So the first one would be cash. And this obviously you might be familiar with. This is a very low risk investment type where you usually just invest your money and you receive a specific interest rate, if any at all. So examples could just be the savings accounts that you have at a financial institution, or if you are invested, there might be investments like money market investments where, again, it's a low risk, a low return, really designed to be a liquid type of asset that it doesn't have much of a risk of losing any money. So that's the first asset class, cash. Typically, things like short-term investments where you know exactly what's going to happen and it's very predictable. But as we mentioned, it is a lower return that's expected. So that's where things like fixed income come into play, where fixed income investments are typically riskier than cash. But they're usually less risky than equities, right? So this is where your investment can be in something like a bond or a mortgage, where it pays a regular income payment with set interest rates. So fixed income investments are often good for investors who maybe don't need their money right away. They want to earn a little bit more on their assets, but they don't want the risk of, say, being in the stock market and potentially losing in the short term. So even though it may miss out on those long-term gains, it provides you a return that's more predictable and has that low to medium risk level. Lastly, I'm going to go through equities. So again, equities, there's certain terms that we throw out there. Stocks, basically it's ownership in shares of a publicly owned company. So that's what the term equity, when I refer to it, means. So equities are generally higher risk investments than the other classes I just mentioned. They can change quickly in value, right? So there could be volatility in the markets as well. And obviously, we do this because of that long-term gain, right? That potential for higher growth comes with higher risk, but higher growth in the long term, as I showed you with those bull and bear markets. So those are the different types of, just a simple introduction of the different type of asset classes that you might be dealing with when you're investing your money. So the next thing I want to discuss is some of you may just be managing your money on a personal level, but many of you may also be managing your wealth for a First Nation community. And you know what? It's more important to understand the exercise of stewardship and responsibility. I know Kristen's going to talk about fiduciary responsibility and being entrusted with other people's assets. So I think it's at this point, it's also important to understand investment risks, right? And what are some of the risks that you might just need to be aware of? Not that you have to fully understand them, but that you, when you're investing your money, you're getting growth, it does associate itself with risk. So I think it's important as we kind of go through the basics here to understand what are some of these types of risks as you're investing. Some of these risks might be more prominent than others. So what are some of these categories? So first and foremost is one of the main ones, which would be market risk and volatility. So the market is a market, and it's normal to have unusual, predictable ups and downs. So these short-term changes in the market and in market performance is known as market risk. And how much a price of an investment moves, either up or down, this is what we refer to as volatility. So investments that increase a lot, they could be, or decrease a lot, could be very volatile, right? Investments that don't change much over time, that's what we refer to as less volatile investments. So just as again, as a simple example, if you have an investment fund that invests in equities, it's more likely to be going up and down with the markets. So it might be more volatile than, say, an investment that has more cash underlying in it, where it's much more predictable, less growth, but less volatility that you might experience here. So again, this is very normal, but certainly there's risks just in market movements on a short-term basis. The next type of risk would be really the strategy of managing market risk and just maybe understanding, how the economy works and why are markets moving in certain ways, I think is really important. Oftentimes we think of when markets go down, that's when we focus on volatility. And there could be things like recession. So just the economy is generally declining, and that may obviously impact market performance. Obviously, there might be other things like when you're thinking of diversifying. So if you're just all invested in Canada and the Canadian economy goes down, that can maybe impact your portfolio more versus if you diversify, which would be a strategy of managing market risk. Not that it may exactly affect performance, but certainly it may minimize those risks or may minimize some of the market ups and downs that you might experience in a certain market itself. So investing in foreign markets is certainly another way to offset market risks, making sure you're diversified. This is one of the strategies that is available to you. All right, now when you're investing in fixed income investments, there's another type of risk called interest rate risk. And this is the value of your portfolio changing based on interest rates. So when you think of fixed income investments, they can certainly provide a safe haven from stock market investment risk, but they might be more susceptible to, say, interest rate risk. So changes in interest rates affect the value of bonds, and they may go up or down. Usually there's an inverse relationship with the movement of interest rates. So again, as interest rates go up, the value of the fixed income things, something like a bond, would go down. So how you manage this again would be to diversify. Again, make sure that you have a diversified fixed income portfolio of different maturities, different dates. This is one of the ways to strategize versus this risk. Now, before we talk about inflation, I do want to just simply define inflation because we do hear that word a lot, but what does it actually mean? Inflation is really just a steady rise in prices of goods and services in the economy over time. So as I mentioned, we go to the grocery store, that $100 you had as a budget, that may not buy you as many groceries as it did, say, a few years ago. So, if inflation is rising prices, there's a risk there, right? Of how much does that relate to investing, right? Because when we think of your investment returns, we also have to consider how much of that could just be inflation of these prices going up. So, for example, say your investment earns 3%. But the inflation rate is 3.9%, like it was in 2023, then although you see your investment growing up in value, when you read your statement, the real buying power of that investment may not be as rosy as you think. So in that case, if your market return was 3%, but inflation was 3.9%, it actually means that your buying power is down 0.9%. So when it comes to investing your goals, you have to consider the inflation risk and say a target of retirement, or say you want to buy a product in a few years' time, you might have to account for how much more that will have in cost when you're saving for these goals. So you know what? Even if your investments are performing well, just keep that in mind that that inflation risk and that buying power of ultimately supporting our well-being is really critical there. So inflation can also contribute to interest rate risk. So they are interrelated here as well. So as inflation goes up, things like the set interest rate from the government may rise to counteract with this inflation. So this is where it can affect fixed income investments. And as you can see, it can get a little complicated, right? So that's where we're going to talk about managing it appropriately. But I think the key to this slide is just be aware that this inflation risk exists and it may impact your investments as well. All right, so there are a few other lists. I'm not going to go through all of them, I think, just for the sake of time today, but things like liquidity risk. So, you know what? Sometimes money may be locked up, or if you sell, it may impact the price. So, liquidity risk is just the risk of not being able to sell or access your money in the time frame you want to. So some more different types of investments can be impacted. This I think of real estate as a good example of this. There's also geographic and geopolitical risks. So obviously we see this. I mean, over the weekend, Venezuela, obviously their leader changing. So these things can impact markets as well. Again, they can be very unpredictable. Tariff policies, as an example. So these are all things, again, just to be aware of when we talk about investments, that they can have an impact on the value of the money that you're saving. Last, I'll mention the environmental and social governance risk. So this is really just refers to reputational risk and you know, what kind of governance is a company investing in. Some classic examples are things like a BP oil spill, right, where the company is not governing their company in a good way, where there's lack of oversight, and this can obviously have environmental impacts. So again, that's when we talk about your money working hard for you, and you want to make sure that your money is aligned with your values as an investor as well. And where we all come together. So how do you minimize these risks? We talk a few concepts already, but one of the drivers of your portfolio performance is how you pick and choose those different asset classes. So this is going to determine what we call asset allocation. So the mix of investments. So how much you have in equities versus fixed income. This is going to be what the number one driver of what dictates your performance. So it's important to make sure that you have the right mix to help manage risks, to make sure it's trying to align with your long-term goals, and ultimately keeping your financial goals in track. So there's a couple of things I want to highlight here, again, just to really emphasize. Diversification is one of the strategies you can have to really help you manage the risk of managing your investments itself. So that's making sure you have a mix of different asset types and geographies. So cash and fixed income and equities in your portfolio. That mix is really what we call your asset mix, and that diversification of having different asset mixes within your portfolio itself. So this is really critical. Again, you don't have to be a financial expert. I think just to understand the basic concepts and ultimately how it can minimize your risk itself. So let's go through maybe an example. I think that's really important here, where we talk about a lower risk portfolio would be allocated more to things like fixed income investments and cash. So much more predictable, but potentially less growth within, say, a lower risk allocation portfolio versus a higher risk allocation portfolio, where you see that green bar there. So green bar would represent stock market investments. And as we could see, again, there's bull and bear markets that may impact performance. So this is really key, where a higher risk allocation is going to lead to more volatility, but hopefully more growth. All right. So that's really the key, is you want to set your allocation based on your goals and what hopefully your expectations are. But it doesn't end there. I think that's one of the keys, is that you have to find the right balance, but also make sure that there's no one right allocation for everyone. And once you have a goal established, it doesn't mean your portfolio stays the same until you achieve that goal. because your goals may change and markets may change as well. And this is, I think, really where you want to have a professional to help you with this, manage this, if you're not comfortable doing it on your own, because there will be times where you'll have to rebalance, you'll have to change your allocation. And I think it's really important to partner with a professional to advise you on these matters to make sure that you're making these adjustments over time. Again, the financial well-being, to go to that one last time, you invest, you save for a certain purpose to achieve a certain goal. And again, as your goals change, as they evolve, this is where the management of money is really critical in this case. So as I conclude, I want to just what are the two or three takeaways that you have? Maybe just again another review of markets, of investing, some terms that were a good reminder here. But I do want to just take a few minutes at this point just to acknowledge and thanks everyone for joining the session. Again, I think financial literacy is the way that we impact financial well-being. And I know wisdom is one of the seven sacred teachings that I know Kristen will be reviewing. By trying to learn and understand about investment concepts, it can certainly empower you to manage your savings, to make sure that you have that experience of growth, and ultimately to improve your financial well-being. Now, I know, understand, and fully believe that the impact is immense, and not only for yourself, but also, again, for your families, for your communities. We talk about children and teaching them about these values as well. So that was kind of one of my goals, is to make sure I lay that information out to you, some of the basics, that you know that you can really possess this knowledge about investments yourself. And the usefulness itself, it goes towards the community. So I think that's where we're going to transition to in terms of you're good yourself and your personal finances. Now you have the wherewithal to manage investments in your community and those community funds. And you might be relied on to make these decisions. And this is where, again, partnering with financial professionals will be a key, but having that confidence yourself, having that knowledge yourself is really key. So I know as we transition here that Kristen is certainly an expert in matters of supporting communities in that group space that for the stewards and stewards of Indigenous communities. So she's certainly going to be talking next about, I guess, that community aspect and ultimately how to invest and with responsibility and purpose within the community. So with that in mind, I'm going to pass it on to Kristen to go through those.
Perfect. Well, thank you so very much, Mike, for kicking us off with that great Investing 101 foundation. So over this next section, we're going to go through why community investing is important, what a fiduciary is, and who this may be applicable to. We're going to go through, again, some key principles of community investing and some practical governance steps that you can take. And then, of course, call out any red flags to be aware of and maybe give you some last takeaways, call to actions. So let me start with a simple question. Are you a fiduciary, or do you know someone who is a fiduciary? So much like an Inishuk, which is traditionally guided travelers across the lands, fiduciaries help guide their communities towards financial security, resilience, and purpose. And so when we're talking about a fiduciary today, we're referring to roles such as chief and council members, band administrators and senior staff, finance officers, or HR professionals within Indigenous-owned entities and businesses. This could be members of boards of directors within the community elders, and of course, next-gen community leaders. And essentially, if you see yourself or you work with somebody that I've just called out that applies in these types of capacities and roles, then this section is definitely meant for you. So why does community investing matter? Why does this topic matter? And of course, what we're aware of is that increasingly the need to manage Indigenous community settlement funds, trust assets, and other forms of community wealth are representing not just financial value, but generational responsibility. And these assets carry the potential to support long-term sustainability, self-determination, and meaningful community impact. So strong governance and informed decisions making processes are essential to ensure that wealth serves both today's needs and, of course, generations to come. And so many of you, through your roles, may have the opportunity to help your community invest with clarity, confidence, and, of course, purpose, which is why we're here today. So, what is a fiduciary duty? So, if you are considered a fiduciary, there's three main obligations you should be aware of. Number one, the duty of care, making informed, thoughtful decisions, asking questions. There's never a bad question, and seeking expert advice when needed. Number two, that duty of loyalty. Your role is to act in the best interest of the community. It's not for personal matters. And yes, we talked about earlier what's important to know for personal investing, but you can take learn those lessons and now apply it to the community, but with the community's goals in mind, of course. Thirdly, duty of prudence, managing funds carefully. And of course, that means avoiding unnecessary risks, some of the risks that Mike would have talked about, but I'm going to go through some other community related risks shortly as well to be aware of. And you need to ensure, of course, or help with that long-term sustainability of your community's assets. So know that you don't have to be a financial expert to fulfill these obligations, and I don't want that to scare you. The expectation as a fiduciary is to demonstrate that you have a reasonable knowledge and you know when you don't know enough to seek appropriate support. And once again, asking questions isn't a weakness. It's actually part of meeting your fiduciary duty. And this is where experienced institutional partners, possibly like the Canada Life Institutional Investments team that I'm part of, we can help support fiduciaries with structure, expertise, and of course, governance aligned investment solutions. So managing wealth, just next slide there, Mike, thank you. Managing wealth for a First Nation community is more than an investment exercise. It's a responsibility of stewardship. So fiduciaries are entrusted not only with the asset itself, but for future well-being of generations. And the assets that I'm talking about, this may come from settlements from the Government of Canada, as an example, land claims, agriculture claims, fishery claims, or it could come from intergenerational resources. That makes prudent, transparent, and value-aligned decision-making essential, and balancing financial security, cultural responsibilities, and long-term sustainability. It's a lot. And to support that responsibility, I want to highlight 6 foundational investment principles that can help you as a fiduciary make sound, community-centered decisions. So the first one, purpose and time horizon. Starting with a simple question, what is the intent of this money? What is this money for? Some funds are needed for the near term. Maybe it's building a school. Maybe it's an infrastructure project for your community. Others may be intended for long-term goals, like supporting future generations. Maybe that minimum legacy balance that needs to meet or wants to be maintained for the community and generations to come. And of course, that's where the time horizon shapes your strategy. Short-term needs, safety, capital preservation, liquidity, as Mike described. And long-term goals, that's where you can take on more equities, growth. And of course, your goal is for long-term sustainability. The second piece to be aware of is account structure. So different objectives, of course, are going to require a different vehicle. So there could be a trust structure. It could be a non-registered account. It could be a pension-like arrangement for retirement purposes. So the right structure improves tax efficiency, strengthens governance, and ensures investments align with the community's end goal for that bucket of money. And of course, good fiduciary oversight starts with getting that structure right. And I'm going to dig into that shortly on the next slide. The third one, of course, is risk versus return. Mike talked about those risks and the potentials for return depending on the different asset classes. And the key as a fiduciary, when it comes to measuring your success, it's not about chasing the highest returns. If you've got short-term goals, you're likely not going to have that equity allocation that's going to achieve high rates of return. That can't be your benchmark, right? And so part of your goal as a fiduciary is to aim for the most appropriate return. That's what we call risk-adjusted returns. It depends on the goal itself. And we have to balance the growth while protecting principal. The fourth thing is diversification. Mike talked about this previously. The key is your role here is to help make informed decisions to spread those assets across different asset classes, regions, maybe even investment managers. And of course, relying on one single outcome, as we often say in practice, one single manager is never going to be the best at anything, right? And so this is where you need to diversify all different aspects of your investments. Number 5 would be outcome and value-based investing. So today, communities increasingly are asking, what impact will my investments have? Because it can be beyond returns and achieving that goal for a community. So value-based investing aligns financial decisions with community priorities, respect for land and culture, social well-being, environmental stewardship, and strong governance. So success is not measured only in dollars, but it can actually be measured also in outcomes that strengthen the community over time. And then, of course, we've got liquidity. Once again, Mike hit on this a little bit earlier. And liquidity asks, how quickly should I have access to my money, and how much of my money do I need access to quickly? Because we need to be able to match the investments, short, mid, and long-term needs, with the investments themselves, like the flexibility and the ability to gain access to these assets when needed. So the bottom line is the fiduciary responsibility in a First Nations context extends well beyond the performance. It's about financial security for the current and future generations, cultural integration through value-aligned decisions, social and environmental well-being, and accountability through strong governance. So when a fiduciary applies these principles, this is where you get investing with purpose. So going to the next slide, I want to focus on the importance of choosing the right account structure. So on the left, what you're going to see here are individual accounts, investment accounts. Mike didn't have a chance to get into these, but the key is that as an individual, when you're investing personally, you may leverage a different type of vehicle depending on the goal. You may be familiar with RRSPs, registered retirement savings plans. You wouldn't put your money that you get from a per capita distribution likely into an RSP if your intent was to use that money for lifestyle needs today, or for a vacation, or for some sort of short-term goal like a house acquisition. You'd only use an RSP for retirement savings. So there's the same importance applies now also to the group side. And on the group side, a group account or a group investment structure are used to manage dollars on behalf of a group of people. So like a community, a trust, an organization, essentially more than 2 people. And so the types of group investment accounts that also needs to be considered as a fiduciary could include voluntary group plans, like group non-registered accounts, group RSPs, group TFSAs. And that's going to support the savings for employees of potentially the community, the employees of a business on community, or maybe it's even just supporting the savings abilities of the community members themselves. We also have group RESPs as an example. An RESP is a registered education savings plan. When you put money in, it actually attributes potentially Canadian education savings grants from the government of up to 20% for minors. So this is a savings vehicle intended for education savings that allows for not only investment growth, but also for further growth through grants and bonds from the government. And then, of course, there's group structures like pensions. Whether it's a defined contribution pension plan, a defined benefit pension plan. We're having a lot more conversations with fiduciaries on this note because of all the unique considerations that under the Indian Act may apply to our community members, where maybe they hadn't been entitled to contribute to CPP and they don't have a proper retirement nest egg set aside for retirement. And with community now coming into large, payouts from the government, of course, long overdue. This is now that opportunity to sit back and look as a fiduciary for the community to say, has my community had an opportunity to save for their retirement? And if not, is this an opportunity for us to create a pension solution or retirement solution for our community elders today and for generations to come? And so I have a pleasure of being part of the group to explore those types of conversations. And our team, for example, we sit alongside fiduciaries and not just ourselves. In a situation like this, this is where we would be one of many financial professionals that sit at the table alongside yourselves and your counsel and your chief and the key stakeholders. So I'm talking like the legal counsel, your tax team, right? And the governance advisors and the institutional investments professionals. They're there to help you with delegated investment solutions, to build customized portfolios, and to provide ongoing portfolio oversight, recommendations, guidance, and ensure that you have purposeful investment outcomes. On the next slide, I know we've talked about now investment structures. Well, this is, of course, very important. But once the community assets are pooled in one of these types of group plans, the most important question becomes, how are the decisions actually going to be made? And how do we ensure those decisions remain responsible over time? Because it's not one and done. It's not static. It's going to change and it's going to evolve. It's going to change and evolve with the economy. It's going to change and evolve with the goals of the community. Lots of different factors, of course. And so strong governance is the backbone of responsible investing and ensures decisions are transparent, accountable, and aligned with community values. So here's 4 practical ways to build it. Have a diversified, not only investment portfolio, but committee and advisory council. So you want to include diverse voices, elders, maybe past council members, youth, future leaders of your community, financial professionals, as I talked about earlier, and cultural advisors. So diversity, of course, ensures financial expertise and cultural integration. The second piece, you're going to need to create an investment policy statement. An investment policy statement essentially is your roadmap. It sets out the purpose of the funds, short-term versus long-term. It sets out the risk tolerance and what type of acceptable investments your community is willing to take on. It takes into consideration ethical and cultural guidelines. For example, we don't want investments, that invest in firearms, or, we have a desire to have sustainability in mind when we choose our investments. And it also could include things like reporting requirements. Without an investment policy statement, decisions become inconsistent, reactive. And of course, an IPS is really kind of that key, that guide, not only for yourselves as a fiduciary today, but for any other fiduciaries of the future. And of course, for all the financial professionals that need to be involved in making these decisions. The third one requires due diligence. So before approving any investments, make sure that you're working with investment professionals that can give you written proposals with clear objectives, the risks, and fee transparency. Of course, hidden costs can erode your returns. So you want to make sure that that's all clear in advance. And of course, check cultural alignment. Does these investments respect our community values? And fourthly, monitor and review your strategy regularly. So I said this before, Mike even mentioned this, it's never set and forget. This review of your investments needs to happen on a regular cadence. And I'd argue semi-annually to at least annually. You're going to want to sit back yourself as a fiduciary, but along your committee, your peers, and ask things like, are we meeting our goals? Have our risks changed? Have our goals changed? And of course, update that investment policy statement as community priorities evolve. Once again, that's where a financial professional can come into hand to help support that. And their job as well is to not just listen to what you believe is changed, but to also proactively inform you on what you may need to consider. Mike talked about real estate and alternative investments as another asset class. We're often seeing that investment policy statements, if they're outdated, don't have essentially an allocation to these types of investment vehicles. And so a proper investment professional should bring that to the table and mention, hey, we notice we don't see that you have the ability to invest in these types of instruments. Let's talk about how they work, why you may want to consider them, and help enable yourselves as a fiduciary or your community members to make an informed decision on whether that needs to change. Now, just going to the next slide there. And so we talked about fiduciary oversight for yourself, but the next step is understanding who can help carry out that responsibility. We talked about building a team, of investment professionals, but also tax, legal, governance, and cultural representation. But the key is when we look at delegated investment management, you should be aware of a couple key components. You're going to want to make sure you're working with a trusted partner who can support your governance, uphold your values, and help navigate complexity with confidence. So I'm just showing on the screen maybe a value-aligned investment partnership, what it could look like as an example. And of course, this is aligned with the 7 sacred teachings, as you would be aware of. So when it comes to love, we're talking about commitment to client well-being. If you hire an investment professional, you're looking for someone who wants to act in your best interest, and whether it's personally or as for the community. You want someone who wants to act in the best interest of the person that they're serving, demonstrating care through fiduciary responsibilities, because they also have a fiduciary responsibility. Respect, honoring the community's vision. So you're looking for investment professionals or professionals that are going to listen deeply, honor your structures today, and integrate cultural and ethical priorities into your decision making. When it comes to courage, making difficult decisions, markets are uncertain, as Mike touched on, but having that courage to show up and have hard conversations and help you walk through these periods of volatility. The markets aren't always going to go up, unfortunately. But if you have the right team that can help you weather the storm and a portfolio that can best weather the storm, you're going to be okay. Honesty and transparent communication. Of course, you're going to want to work with somebody who's dependent and honest, providing you clear reporting, transparent fees, disclosures of conflict of interest, and have open, frank, raw conversations about risk and performance. You're looking for someone with wisdom and shared expertise, a strong partner with deep expertise and shares it with you. Education and knowledge transfer, of course, builds capacity and empowers fiduciaries to make informed decisions. When it comes to humility and collaborative partnership, an effective partner does not dominate decision making, and that's not what an investment professional should be doing. You can have what's called delegated investment governance, where you delegate it off to an investment professional to make all decisions. But if you yourself or your community want to be involved in the decision-making process, their role is really to help you make informed decisions and to help guide you to that end goal. And last but certainly not least, when we're talking about truth, living all the teachings, truth is the integration of everything we've discussed here today. A strong investment relationship is built on authenticity, consistency, and alignment with long-term goals, not only financial, but of course, social, cultural, and environmental. So delegated investment management works best when it strengthens governance, respects community values and authority, respects shared values, and the right partner should carry this forward. But of course, be aware of some risks, and just really at a high level on the next slide, you want to make sure that you're not working with anybody that's making empty promises, guaranteed high returns, long-term not telling you about long-term lock-ins. So what Mike talked about liquidity. So not warning you about when your money could be locked up, not providing you transparency. You should have the ability to get access to your statements, see the accounts online at any time, see clearly how much you're paying and what each dollar is being paid for. What's the value I'm getting from these fees? You definitely want to make sure there's no misalignment with community values. And of course, avoid any conflicts of interest. So whether that's personally or working, of course, on behalf of a community, you don't want anybody that is biased, hiding fees, commissions, selling only proprietary products. That's not acting in your best interest. And so be aware of these risks. So in summary, just going to the key takeaways. In Indigenous culture, wealth is not possessed. It's held in trust for those who have come after us. And your role as a fiduciary is to protect the community's assets, grow them responsibly, ensure decisions reflect community's values and visions, and seek out guidance where necessary from investment professionals. So what's next? Start by asking questions. Do you have an investment policy statement? Are your investments aligned with your community values and goals? Are you educating your members about financial stewardship, community members, your board members? And do you have an investment professional that understands the solutions that are available to you to help you make informed decisions? If you say no to any of those answers today, I think that's your cue to seek support. And of course, on behalf of the Canada Life Institutional Investments team and our group retirement savings team, it'd be our absolute pleasure to support you in any capacity. So please do not hesitate to reach out to us at any time, whether it's today for our question and answer period. I know we only got a couple of minutes left, or in the future.